And then one last thing that I wanted to talk about today is kind of the seasonal factors that we're dealing with. So we are now in October. My kids are getting ready to go trick or treating. Don't know how much longer as they get older they're going to be enjoying that, but we're enjoying it for as long as we can. Fall is in the air, pumpkin spice. I'm not a pumpkin fan, but everybody else is apparently. And by the way, these are the 3 months as we head into the end of the year that are the strongest for investors. And this repeats itself over and over and over in the market. Um, J Rod, you're a statistical guy. You've run the numbers, and we've talked about this a lot. This is
Hmm.
a great period to be an investor, and especially in a year when the market is already up year to date.
Right.
And after we've had a sell-off in August and September, markets are a bit oversold, so that just gives us even more firepower for markets to be mean reverting, move back up just because they're oversold, because it's a seasonally strong period of time. Oh, and also because it's a politically strong period of time as we move through this year, heading into the presidential election next year. This is a time where it's just natural that Washington does whatever they can to juice the stock market, so investors are happy with the incumbent, and it helps to get the existing administration reelected. So that can be a problem and a concern. But as far as the way that we trade today's market, this is a good time to be an investor. Earnings season is also kicking off. So at the end of this week, we're going to get the first few major earnings reports from banks, and then moving into next week and the week after, the variety of earnings reports will pick up, and we'll start to see energy names, industrial stocks, tech stocks, financial stocks. We'll get a much better picture of kind of the whole overall economy based on how these companies are performing. And I think it's going to be a good one. We've already started to see analysts increase their earnings expectations. And so far this year, while there's been a lot of fear of recession coming in and of consumers quitting spending, and there are some legitimate concerns on the horizon. So far this year, the market, individual companies, and the overall economy have been resilient, and they've been beating those expectations. So until that changes, we need to make sure that we keep our optimistic hat on and give the market the benefit of the doubt until shown otherwise. So a few areas that I think we need to be focused on for technology. I want to stay away from the speculative tech stocks that are expensive, that have profits that are far down the road, but aren't generating profits right now. But I do want to focus on the blue chip tech stocks that are generating plenty of profit right now and that have plenty of cash on their balance sheets. Yes, we've talked about this plenty of times. I know I probably sound like a broken record, but at the same time, if we're making money with these stocks, why not keep going? So a couple that I think we should keep an eye on are Google, ticker GOOG, or you could go GOOGL. They're both basically the same stock. And then Meta, the former Facebook, META. Both of those companies are generating plenty of cash flow. Both are tied to this AI theme that investors seem to really, really love, but they're tied to it in a way that they're actually making money. It's not just a concept for Google. They're actually using that within their products that they offer their customers, and helping to increase the value that they give to their customers, which also allows them to increase prices over time. And Meta the same way. They've got a lot of projects that are underway. The stock is not that expensive compared to earnings, and could have a long way to go. Industrial stocks are also good names to keep an eye on. I specifically like Caterpillar, ticker CAT, and I do have a personal position, an options play that I've got on Caterpillar right now. I think that we're going to see a lot more infrastructure spending. So even if we move into a recessionary period, we'll see the governments respond to that by having infrastructure projects that help to create jobs and help to sustain the economy. So in a bad time, industrials hold up relatively well. But even in the good time that we're in right now, industrials should still hold up because we've had so many political pressure to bring jobs and manufacturing back to the United States. So Caterpillar is selling a lot of equipment as new data centers are built, as new warehouses are built, as new factories are built to manufacture computer chips and plenty of other things. All of that leads to demand for Caterpillar's equipment. So that's a name that I think you should focus on. And there are plenty of other industrial stocks that you can keep an eye on as well. And then finally, financials. And we're going to be getting, as I said, earnings reports from many of these big financial companies. I think that I would stay away from the regional banks because there's still a lot of challenges that they're facing because of these higher interest rates, because of their bond portfolios that are under pressure, and because investors are worried about deposits. So they're moving deposits out of these smaller regional banks and into the large investment banks that are seen as too big to fail. I don't love that because it's not really good for our communities. But as investors, we have to trade what is happening, not what we want to happen. And right now, the competitive tables are skewed in favor of the big investment banks. Because we're in a bear or bull market right now, we're starting to see more IPOs, which is initial public offerings, brand new stocks coming to the market. I think there was another one priced this morning, or maybe it was yesterday, but there's several of these big companies that are coming to the market that are starting to trade. And you know what? The big companies or the big banks like JP Morgan, Goldman Sachs, Morgan Stanley, Citigroup, they all make lucrative fees by helping these companies come to market. A company like JP Morgan will actually do a roadshow, and I've been to many of these roadshows with a new stock that's going to be listed. So they'll go to hedge fund managers, pension fund managers, mutual fund managers, and they'll sit down and they'll have a dog and pony show, a nice lunch. They'll show you all the things about this new company that's coming, and they'll basically ask you to give them an indication of interest. And I used to do that at the hedge fund all the time. I would be interested in buying 5,000 shares of this new stock or 20,000 shares of that new stock. And so they aggregate all of these indications of interest, and then once the IPO comes public, once it starts trading, they give those shares to their favorite investors who they think will help drive that stock price higher. Well, here's the thing: a JP Morgan gets to keep a certain piece of every share that they sell to the institutional investors. So if it's a let's just say it's a $35 stock, JP Morgan might keep $1.50 of every share that is sold to their customers as a commission for helping this stock get up and running. And those fees really, really add up. So JP Morgan could be generating millions and millions and millions of extra dollars in fees as more companies come to market. And the same thing happens when companies refinance their bonds, which is a big issue right now. Now that interest rates are higher, companies have to refinance their debt. They're trying to get the best deal that they can. They talk to a company like JP Morgan and say, help us out. And right now, we're seeing a lot of corporations refinance their bonds to shorter duration, shorter term bonds, because they're hoping interest rates move lower over the next 2 years or 3 years or 4 years so that they can then refinance at a lower rate. Well, all that does is it creates more fee income for JP Morgan because they can refinance the bonds right now. And then they know in 2 years, this customer is going to come back and they're going to have to do the same thing over again. And they're going to make a big profit right now. They're going to make another big profit in 2 years. And investors right now are willing to pay more for shares of a JP Morgan and I'm expecting some of the other investment banks as well, because they've got that recurring revenue already set up and because those fees are becoming more and more lucrative. So just something to keep in mind as we move into earnings season. And remember, these banks are going to be reporting first. So I would move quickly on the financial names if you want to buy. JP Morgan is the name that I would pick in that industry, but before the company reports earnings.